And we knew that a lot of people already pushed out the 2019 tax filing to later. So they're probably just now start to think about, oh, July 15 is here. I need to file taxes. That is, a lot of people are doing that. But what we're here saying to you is that hold on to it. Hold on and wait. Let me tell you several tips before you finalize your 2019 taxes, okay? So don't rush into filing your taxes until you understand this webinar. Today's webinar has a lot of connection to a one I did about a month ago. It's called the Outline of CARES Act and the Tax Changes for Individual. If you come to YouTube and you will see this one, this covers more content than what I do today, because today I'm just gonna focus on 2019 and for you filing this tax return. So some of the incentives for 2020 I am not covering. So I just gonna mention to you what's important for 2019 filing, which is due in 10 days time. All right, so fast forward, and I already have talked about information, showed you about the firm YouTube webinar, and then we also have this no responsibility disclaimer, and which really important because you don't want to trust the third party, what they say, and when you look for information, you want to go for the sources, you know who they are. And then you can learn the knowledge in the right way. So July 15, 2020, okay? So this is the date, and there's several things are due on this date, okay? Estimated taxes for first quarter of 2020 is due. So what is estimated tax? Sometimes when you, especially if you're a small business owner, let's say you're selling things online, and last year you made $100,000 income and paid $20,000 taxes. The IRS rule is that if you paid taxes when you filed taxes last year, and you need to pay for those amount you owe on the quarterly basis, so you need to divide the 20,000 divided by 4. So each quarter you should pay estimated tax for each quarter. So now for 2020, the first quarter and the second quarter are due together on July 15, 2020. And when, there's a big chance for people to make a very to create problematic issues is you simply just gonna pay one amount to second quarter, then not even saying that part of the amount is first quarter. So what here we want to remind you is that even though you pay 2 quarters together, make sure you do 1 quarter at a time, second quarter the second time, and don't combine the payment, because IRS system doesn't understand you're paying 2 at the same time. They think that you forgot to pay the first quarter and the second quarter you paid more, so what? They still calculate the penalty for the first quarter. Okay, so make sure you pay separately, and that's estimated tax. 1040 is also due on July 15. 1040, of course, we know what that is. It's a personal tax return. Okay, so of course, if you're not ready, summer is too much fun, and you just don't have time to do your taxes, then file extension. That will extend you into October 15. Okay. 1120 is also due at this time. If 1120 is a calendar year entity, that is a C corporation. It's a business entity that file tax return due at the same time, like 1040. So business taxes due. If you file extension, you goes to October 15 again. Then second quarter payroll taxes is due on July 15. Okay. Of course, gift tax. Gift tax is like a little shadow child after your 1040. So if you file 1040 extension, your gift tax extension is also there. And you probably, most of the folks probably don't really file gift taxes, but what is gift taxes? Gift tax return, it is when you want to give to somebody money that is over the personal limit. which is 15,000 right now for this year. Let's say if you want to give to 16,000 per person, then that's when you will file gift tax. So otherwise, July 15, what we want to focus today is related to small business and related to 1040. So tax tips. Every time I talk about tax tips, I generally speaking in two ways. Number one is a general tax tips, and they're just things that you need to generally know, and you have to put in the best practice so you don't end up getting audited every year and you don't even know why, but you just getting letters every year, and that to say you didn't really plan it properly, and you probably need to revamp your process of doing taxes and getting yourself really tied down with your tax filing. And I tell folks that if you are really just a disorganized individual and your business is not organized and you're coming to tax time, you're like, well, Ying, I'm just not very good. So I have some numbers all estimated. When we look at your tax, when we look at your document, everything is rounded up to 1,000, stationery 1,000, inventory 5,000. If you do stuff like that, that just says that your record of filing is really not very durable for IRS beat up, right? So in that case, we introduce to you a audit prevention program we have at Community CPA, which we can never guarantee that after you do it with us, you're 100% covered, never gonna be audited. No, there's nobody can provide you that promise. Even Donald Trump get audited. So, but what we can promise is 99% of chance you will not be audited, just because the logic of being audited is not there. So with our data match system, and you're just not going to show up in front of IRS's document to be on the list to be audited. So that would drastically reduce your chance of being looked at. Then, of course, there's other tax tips today that is really, really special because they are related to CARES Act. You're probably going to say that, Ying, the CARES Act just came out in March of this year. I am filing 2019. Are you telling me that I am going to do something about the CARES Act now for my last year's tax return? Absolutely. Absolutely. And I am telling you today that you want to file 2019 with CARES Act implementation in it. We did a tax planning for an entrepreneur. He has 4 or 5 companies, and we did tax planning back in October last year, because that's when we do 2019 tax planning. We did it in October already, okay? But I just wrapped up another round of tax planning because the CARES Act had brought so much change to 18, 19, and 2020. So with the new changes, he was scheduled to make a payment of $35,000 to the government for both taxes, federal and state. And after we implemented CARES Act, he actually doesn't have any tax liability. This is the difference between whether you are bringing CARES Act incentives into your 2019 or not. And you might even need to bring that into your 2018 because CARES Act covers 2018. All right, so now I want to get into the tips. So the first tips I want to mention to you is, we know that taxpayers are getting a stimulus check, okay? So important to the low-income individuals, and that become your 3 months worth of food. And I know that to have the money quick is important. So what happened is if you didn't get the money yet, and you haven't really filed your 2019. Now, before you file the 2019 tax return, you probably should look at whether you're qualified for stimulus check or not. Okay, maybe you don't qualify. If your AGI is high, for example, 150,000 for married couple, and if you go over that amount, then you will not. Your AGI, you will not get your $1,200 stimulus check for you, your spouse, and the $500 for your children, for each one of your children. Okay, so if that happens to you, I would take a deeper look at the tax return to see maybe I should just buy something, maybe buy traditional IRA and to reduce my AGI, and then I will get that money. So there's things that still can be done. So your tax tip number one is, if you didn't receive your stimulus check when file 2019, be objective and know exactly what you get into. And let's say if you just did too great in 2019, you made too much money and you can reduce it and you don't qualify, no problem. In 2020, when you file your tax return, that year you may qualify, you still can get your stimulus check. It doesn't go away. Each taxpayer has 3 tries to get stimulus check. 3, 2018 tax return, 19, 2020, okay? But it is the same check, so you just need to qualify for one of the 3 years. Tax tip 2, I touched on to it. So remember, when we file taxes by April 15, that's a due date, right? You cannot, we tell our taxpayer that, okay, go buy the traditional IRA, and then we can reduce your AGI, and maybe that will allow you to have a cheaper health insurance, or will allow you to have a bigger deduction, bigger itemized deduction. However, we made a decision for you to purchase traditional IRA. But with COVID-19, with 2020, that due date is no longer April 15. That due date is July 15. So you still have time, folks. You still can go to your financial planner and get that purchased. And so that way you come back, you reduce your AGI. So I wrote in here, it's $6,000 per person. And if you're over 50, then you got $7,000. Okay, same thing with Roth IRA, even though it is not immediately generating tax benefit, but if you are into Roth IRA and like to look at the future, believing that the future dollars will have a better return, then you buy Roth IRA. When you withdraw that money, you don't have to pay taxes, right? And I personally, don't really trust the market. So if I can save tax dollar for $1 today, I don't look for $10 of investment for the future, because it's so out of control and the market can go so crazy. And this pandemic proved to us that what the market can do for ordinary people when you don't have any control. Tax tips 3. All right, this is something that really, really interesting. And I don't want you to file 2019 if you have a loss. If, let's say you are running a lawn mowing business and your Schedule C is a big loss, all right? And let's say that loss made you negative and you don't have anything to get refund of, but you also you have a big negative on your tax return. And in this case, that negative you have in the lawn mowing company is called net operating loss. It is your business loss. And here, the CARES Act made a new things for us. It says that if you have a loss in 2018 and then 19 and the 2020, so we're in 19, right? We're filing 19 tax return. If we have a loss in 2019, say in 2000, I have a loss here for 10,000, right? And this loss 10,000, and I can take this loss, apply to 2014. Did you hear me? In 2014, I was making money. I made a $10,000 profit. I paid $6,000 taxes at that time for my profit in 2014. So what the CARES Act is doing for you is, ladies and gentlemen, you fill up a form. That form is 1139. You fill up that form and you put your 2014 taxes you paid, you will get it all back. You hear me, right? So the example is, if you have a loss, business loss, you need to immediately look at what happened to 19, 18, 17, 16, 15, 14. Okay, then you see on 14, wow, I paid taxes on that year. Great, get that money back. If that's not enough, get 2015 back. If 15 is not enough, get 16 back. So you can get all of these 5 years add together, get all the tax dollar back. So I will recommend you, in my slide, I said that if 2019, you're gonna do this claim, you want to start from 2014, please don't go into other years if your 14 has gain. Because when we file 2020, a lot of us, a lot of small businesses will lose money, will file loss in 2020. We can only go back to 2015. So our 2018 loss can go back to 2013. Our 2019 loss can go back to 2014. So our 2020 can only go back to 2015. So I want you to use up the 14, 13 from the other years first. And if you have a loss on the 2020, then we can claim that back in from 2015 all the way up to 2019. So this is the tax tip number 3. Is really important. I want you to understand. That's why I always tell my business folks that in business, there is no such a thing about loss. There's only thing about deferred, okay? Deferred asset. Loss is deferred asset. Asset is a good term, right? Asset means something we have, right? So deferred asset means it is a kind of benefit that got deferred. So losses is never really lost. Losses is accumulated, and once you make money, you will be utilizing the loss and not to pay taxes. All right. That's number 3. I hope that now is part of your knowledge already. Okay. Tax tip number 4, limitation on losses. Okay, so this is something implemented, and when Trump came on board, that TCJA, I call that Job Act that was put in. And what it says is, let's say I'm running a lawnmower business, right? So let's say my years, I actually lost $300,000. I have a business loss $300,000. And not to talk about how I got that much loss with the lawnmower business, but who knows, maybe I mowed over people's treasure, so I have to pay and whatever happened. So I lost $300,000. And the 2018 Job Act says that, I'm sorry, you can only reduce the business loss by $250,000 maximum. You cannot do more. And we don't allow you to write it all out. Even though you had a capital gain of $500,000, I'm sorry, you can only do $250,000. So that is the Job Act we had in section 461. The CARES Act made changes to it. Actually, I didn't make change to it. It just took it away. The CARES Act just erased it, saying that, oh, don't listen to it. It is not existed. So that's what the CARES Act was doing. So CARES Act eliminated the restriction and saying that no, you can offset. You can offset. It doesn't matter. Even though it is not the same kind of income, you can offset. So that's what CARES Act giving you. So I know that you may not have $500,000 loss in 2019, but for those people who happen to sell some properties with big gain, and then they also have losses from their operating expenses, let's say that is a 300,000, then they had a capital gain $1 million, 300,000 business loss, that can offset each other. So we only pay 700,000 on capital gain taxes, right? So that comes in handy. And really, when you file your 2019 taxes, you need to make sure that that CARES Act is already implemented in your calculation. You cannot go use the form that created like before March of 2020, because those are the tax forms that still have Job Act, the requirements there. So, a lot of times, I myself, I don't really rely on computer, but there's so many tax preparers out there. All they do is how to use computer. So they type in your number, that's it. The computer say, spit out a $5 refund, that is $5 refund. But for me, and when I look at the $5 refund, I actually have a reference in my mind. I was expecting 10, then you only got 5, so I look around. I look to see where I created that difference. So with that, so I want you to be sensitive to your computer printout. If you do that in TurboTax, or if you have a tax preparer that not so updated with CARES Act, that is a huge disadvantage for you. You need to know what's going on. And in my other webinars I showed you earlier on YouTube, and that one summarized 13 tax incentives for the CARES Act. Actually, this Saturday, 3 o'clock, I am going to cover CARES Act tax incentives explained. That was my title for Saturday. So I will dive into everything related to CARES Act, related to taxes. So it will definitely have a little piece of 2019, but it's also going to have 2018 and 2020, because those are the years. If you have never get engaged with a good tax preparation firm, this is the year that it deserves that investment. And because there's just so much room for people to do wonders for you. So you want to give those tax preparers, you want to give Community CPA the chance to show you how things can be different, how we can do better, right? So that's our tax tips 4, which is talking about offsetting between different incomes and losses, and the limitation from the past basically evaporated. And we just have the CARES Act took that out, so now we can offset. And to some people, if you don't even know it cannot be offset, I guess you can just forget it, because that never really existed. All right. And the modification of limitation on business interest. This is a section that maybe smaller businesses are not so tuned into this one, but there's a lot of tax planning coming into here. And so, for example, the companies, between companies, they can do promissory note with each other, interest, lending, and borrowing. A lot of large companies and international companies are using the business interest to be a huge way to do tax saving. So for that, there's a tax regulation to prevent people from doing too much of that. It is called 30% of limitation on interest based on adjusted taxable income. So adjusted taxable income is a formula. It is what your income minus depreciation and all of that, and they come up with a number. And it says that as a business, you cannot deduct more than 30% of your adjusted taxable income and as your business interest expense. So basically it's an expense entry, but they kind of put a limitation behind it. So the CARES Act said, other than partnership return, and you don't have to worry about the 30% limitation anymore. They give it to 50. So a simple example would be that, let's say if I have a business and I only made $10 profit, okay? But I borrow my mom's money, I have to pay her rent, I have to pay her interest back to my mom. And so I pay $9 to my mom on interest expense. So normally in your imagination, my $10 minus $9, my real profit should be $1, right? But no, the act says, wait, you had a $10 profit, you owe your mom $9 interest, but you're only allowed to deduct $5. Okay, 50%. But the new rule is you're only allowed to deduct $3. So whether it's $7 finally taxable or $5 finally taxable. So basically that is another tip. So if you have that relationship in your tax return that you're looking at deducting business interest, maybe it is already so much under the threshold, you never really paid attention, but there is a limit. There are people, there are businesses are utilizing that as a way to move revenue around. Okay, so I just want you to be aware of, and that is available for 2019. Why are you waiting for getting to know that in 2020, when you file 2020 return, then you look back to your 2019 goes, why do I not do that when I was filing 2019? That's a good question for your tax preparer, okay? And our last tax tip, number 6, this one is a really important one. This is the one that earlier I was telling you I was redoing this business tax planning. We did that last year, October, but I redid it recently because of the CARES Act. And I utilized this tax tips number 6. Let me give you a real business example. So we have businesses who opens up franchise in the mall. So like Victoria's Secret, they're not my client, but I'm just giving you example. So they open up their retail stores everywhere in the mall, right? So when they go into the mall, they do renovation to that retail space. That retail space, interior renovation, that one in 2018, when Trump pushed through the Job Act, and they changed it. They are saying that, oh, well, and we're gonna make you do 39 years depreciation. So they took that part of business, they took that part of money and disallowed people to fast depreciate. So you cannot write it off right away. And so that applies to 2018, 2019. And so when 2018 tax return time coming in, there are people who have done a great deal of improvement because they were thinking about 2017, but now realizing this has been changed. So they actually lost the chance to get more deduction. So they ended up paying taxes or paying more taxes, right? So this CARES Act recognized that change in Job Act and took it out, and they changed it back. So what happened is the CARES Act says, no, it is a 15-year depreciation schedule and not 39. By changing to 15 years, it made the renovation piece, let's say that's 200,000, made that subject to bonus depreciation. So you can write off 100,000 right away, or you can use section 179. So which is to write off the whole thing in one shot. So see how much that impacted people who had already filed 18 and ready to file 19. So we look at the asset piece, we look at the spending really carefully to make sure we capture the interior improvements and know that that's a non-residential real property improvement, so we can actually fast speed depreciate it out, and then you don't have to pay taxes, and then you right away save your taxes as what you were imagining, because you probably used to what happened before 2018, but that got changed so unknowingly. It is almost like it was an accident mistake in Job Act, but I don't understand the politics, so I don't understand why such a big change didn't really receive a lot of public attention. And obviously they want to say the Job Act is really, really good, so they don't want to point out something that changes people, creating taxes for some people, really a big time. So with this kind of mall chain store, you know how they do this, they open up chain stores every year, they have qualified improvement property every year. So now they could easily write it off, and like buying a Starbucks coffee, so you can write it off, right? So this is the one that when you file 2019, the CARES Act is already retroactively back to 2018. So you should not use the Job Act to apply for 2019. You need to know CARES Act is here. You need to change it. So a lot of tax software probably hasn't even updated yet, because it is just so much change and it's so new and not a lot of people knowing it. So you want to know what I'm talking about. And if I am making this too complex for you and you felt like you didn't really understand, I welcome you to give me a call, because you need to know what you're doing for 2019. Do not file 2019 based on 2018 Job Act. That will be the, if I have to just give you one sentence to finish today's webinar, that would be what I tell you. And I want you to file 2019, your company return, your personal return, file them with implemented CARES Act incentives. And you can file extension for your company return. So the pass-through entity like the 1120S and a partnership, you already extended it on March 15. So you have till September 15, enough time for your preparer to learn CARES Act. And if they don't know what you're talking about, just give them a link on my webinar. And I am pretty sure there's a lot of tax preparers are listening to the webinars as well. And we want to give you that free exchange. So we're being, small business owners, and you and me and all of us get educated. And it is at the end of the day, if you ended up paying more taxes and there's nobody benefit, is just you pay tips to IRS, they really want you to use your money to grow your business, but you don't want to, and you want to give to the government, and so they can play kindergarten games, that's fine. So, and I mean, I want to make sure that my tax preparers, my tax payers all get educated, so we know where we're going and we know how to make change. Let's say if you are saying that, well, Ying, you talked about all these tips, but I already filed my return. What do you want me to do? And there is other avenues we can go to make change to the return. I am not talking about amended return, okay? Amending a tax return is my last draw in any solutions I will find in tax world. There are changes, requires one form, requires a write-up, and I would not file amended return. I would go with your current tax return, but making changes on the current and to calculate the impact of prior and bring it to the current. So one of the example would be right here. If you look at the slides, it says that you can file a form 3115. That is a change in accounting method form. Change in accounting method form just means that you are changing the way you are calculating income and expense. Anything that triggers you to calculate more expenses, So you reduce your taxes, you want to report that on that form. So we can use that as a way to get your prior year fixed. But of course, if the amending return is really beneficial, yeah, I amended return. I amended a 3-year tax return. My biggest, and I guess if we measure by refund being successful, my biggest refund for the amendment for a manufacturer where I change their accounting method. I change their inventory counting method. By doing that, and we got the taxpayer, my client, they received $263,000 tax refund. Okay, so yes, there are things like that, and we can do, and as long as we understand the government procedures and understand government act coming out, what incentive they're trying to implement to help, and all the businesses should equally benefit, should not limit it to those ones who can go to large accounting firms like KPMG, McLadry Poland. Only those people can speak a real tax language, and here we are just all speaking Chinese, right? And I want that to be available to people doesn't have those jargon languages like myself. And I don't, I really don't know how to speak big words. I'm really plain, but I think my brain is really very well organized for what the government is trying to do for small business. And I summarized the 6. I hope that's really, really helpful. And I have a last note to give you is to say that, folks, if you are a small business, always keep in mind, you're not gonna save big taxes by saving a receipt of a Starbucks coffee, okay? And the saving taxes is not about spending. If you're only gonna spend money in order to save taxes, you are at rudimentary level for tax saving actions. You're not growing up, and you are really not utilizing intelligence available right here to save your taxes. Tax saving comes only with a combination of understanding the Tax Act and also knows how to apply. So you're not gonna easily, most of the people, without planning, you don't easily fall into a tax incentives. Sitting right in the middle of tax incentive goes, oh wow, I just landed here and got so much refund. That doesn't normally happen, okay? What really would happen is the Tax Act and you plan your course of business. And you're aiming that saving, you're aiming that refund, and then you can do it properly and I'm not saying creating books, no, I am saying that treating your book and by standard, but knowing all the benefit you're gonna have, so you will guide yourself into that tax incentives, okay? So this is how people hire accountant to do tax planning, not because they're fortune tellers, it's because they know what to do and what you do today, so to get that tax incentive. And we, at Community CPA, we're kind of, we're the artist people. We actually like to draw. So all of our clients, when you have multiple businesses, you come in and we draw a chart for you to see where you are, what is your refund today for 2019, what kind of incentives that we're aiming at, and how we got there. So it is kind of like a one page for all of the paper you need to have. And we have we have our clients, and literally so many businesses, but every year they only get one piece of paper, because that's all they need. They don't need the rest of the filings. It's all on the system. They can go to their portal, get a copy, but all they care is that flowchart we create, because that guides them throughout the year. So I want to say that planning is important. And before you file your 2019, folks, please look at the 6 tax tips I gave you, and hopefully you get to save some tax dollars that you didn't even know existed. And I hope this webinar is short, but I want it to be to the point, and hopefully you liked it. And go to YouTube, like us, and follow me again on Saturday, and I will expand on the CARES Act tax incentives summary. I will give a summary of everything in that act, and to give you a rundown, so that way we are all informed. And it is also a good opportunity for me to learn, because when I know I'm teaching, I am learning. Isn't that good? I think that's a really good deal. And give us a thumb up, and I really appreciate your time. And see you on Saturday. Bye-bye.